Indian banks, which bear the brunt of bad loans in the last decade, seem to have crossed the hump. The latest financial stability report from the Reserve Bank of India indicates. According to the report, gross non-performing assets or GNPAs as a percentage of advances have declined from 11.8% in March 2018 to 3.9% in March 2023. This is the lowest in a decade. The net NPA ratio has fallen below 1%, the lowest since 2010-11. At the same time, the loan loss coverage ratio, an indicator of banks' balance sheet strength, is 74%. Both the capital adequacy ratio and the common equity tier 1 ratio of scheduled commercial banks rose to historical highs of 17.1% and 13.9% in March 2023. Clearly, what was known as the twin balance sheet challenge in the last decade has now turned out to be the twin balance sheet advantage, as RBI Governor Shaktikanta Das puts it. Improving asset quality has helped banks focus on loan growth, which according to RBI data is growing at 15.5% yearly. More importantly, retained loans have grown faster than the overall loan growth between March 2021 and March 2023. Retail loans grew at a compounded annual growth rate of 24.8% between March 2021 and March 2023. This is nearly double the CAGR of 13.8% for gross advances during the same period. Retail loans formed around one-third of the total banking system's gross advances.
The banking system has gone through its fair share of cycles, but we do believe that today the balance sheets are far stronger than they've been for the past few years. And this is clearly borne out by the trends that we're seeing in multiple parameters. Firstly, from an asset quality perspective, gross NPAs for the banking system have already hit a decadal low of about 3.9% as on March 23. And when we look at leading indicators such as the quality of the corporate loan portfolio and the CRISIL ratings credit ratio, that is the ratio of upgrades to downgrades, we're expecting a further reduction in gross NPAs this fiscal as well. Secondly, profitability. This was another decadal best for banks with ROAs touching 1.1% in fiscal 23, supported to a large extent by an expansion in the net interest margins. We do believe that NIMs have now peaked. Thirdly, what we've also seen is that capital buffers have also been significantly strengthened for banks. While private sector banks continue to be strongly capitalized with solid cushions over regulatory requirements, public sector banks have also demonstrated strong improvements in capitalization. So if I go back about 5 years, only a quarter of the public sector banks had a cushion of at least 100 bips over the regulatory tier 1 capital requirement. Today, all public sector banks have this 100 bips cushion. So banks are clearly on a stronger footing now compared to the past few years, and this is allowing them to focus on core business areas and growth.
Another area that the FSR flagged is unsecured loans. The share of unsecured retail loans increased from 22.9% to 25.2%. And secured loans declined from 77.1% to 74.8%. Yes, it is true that there has been a sharp improvement in credit culture, and banks also analyze credit bureau data for giving such loans. Yet, credit card NPAs of public sector banks, which have a much lower share in that market, are at 20%.
Specifically on retail loans, we've seen the portfolio at banks double over the past 5 years, and the share of retail in the overall loan book increased about 30% from around 23%. But just a few points to really put this in perspective. Firstly, though the share of home loans has come down, it still remains the largest segment within retail at just under 50%. And here we've seen that banks typically cater to salaried customers with relatively better credit profiles. Secondly, while the share of unsecured book in retail loans has increased to over 25% from just under 23%, a large part of this portfolio is really originated through cross-sell and therefore is expected to be already credit tested with the bank. Of course, all this is not to say that asset quality does not need to be monitored closely. In lending, any fast-growing portfolio needs close attention to credit appraisal and risk management systems to avoid rise in slippages to NPAs. Also, what you're seeing is as the retail book grows, there are some other structural shifts that we're seeing. As an example, the share of rural and semi-urban markets in unsecured personal loans has been going up. And what impact this may have on portfolio behavior will really need to be seen. So overall, we would say that while the current trends in the asset quality of retail loans of banks do not flag off any significant causes of concern, As the proportion of retail, especially the unsecured segment, increases, it will become more and more important to track early warning indicators and shift portfolio strategies or take any corrective steps very quickly if needed.
So Narayanan says the early warning signals need to be monitored closely. In this context, RBI Governor Shaktikanta Das also had a word of caution. He said, it has to be remembered that seeds of vulnerability often get sown during good times when risks tend to get overlooked. While the Financial Stability Report paints a good picture, banks cannot afford to drop their guard.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.